Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, I don't know if you've heard, but there's an election coming up. For me, I'm looking forward to the text messages, the calls, the ads, the advertisements going away, and I'm sure you are too. So I thought we'd look at how the market has reacted. The equity markets have responded from a historical perspective after midterm elections. And the good news is there's good news. So let's dive into that today. How do stocks respond after the midterm elections? So as you all know, in 2022, things have been very rough. We're in a bear market. But interestingly, the second year of a presidential cycle, the equity markets tend to be down. In fact, they're usually down in the second or third quarters, and as of recently, the S&P was down around 21%. But the good news is the fourth quarter is typically a turning point. So obviously, we're in the fourth quarter here, where the equity markets have risen 84% of the time, averaging a gain of 6.4% for the S&P. So that's good news, and any good news we want to hear about, right? Especially these days. So over the next 12 months after the second presidential year, through the end of the third quarter of the third year, the average S&P gain was around 22%. And as of the beginning of the fourth quarter, actually the market's up around 5%. Interestingly, the Dow actually has been up, at least most recently, around 14%. In fact, its best performance since 1976. Any good news we'll take at this point. And historically speaking, since the 50s, you could see, things have been pretty good over the next 6 months. So if the past equals the future, at least theoretically, things should start improving. Through 5 midterm cycles when stocks were in a bear market, October represented a market bottom 80% of the time, with technology stocks being the strongest gainers with an average gain of around 30%. Now, again, the past does not necessarily equal the future, but it tends to rhyme with the future, and it's good again to study history, what that could potentially give us an idea of what may happen in the future. Now, I don't know, I have to tell you, you probably saw the Federal Reserve met most recently and increased, to no one's surprise, the short-term interest rates, or the Fed funds rate, actually 75 basis points, and are committed to, in their mind, taming inflation, and that's the primary motivation. Obviously, the market doesn't like it. In fact, yesterday, right after the 2 o'clock announcement, or actually the Fed day after the 2 o'clock announcement, the market was up around 500 points, in reverse, down around 500. So not good news. And actually, as of the time of this recording, there's still more weakness. So why am I bringing this up? Because yes, if from a historical perspective, the midterm elections, so post-midterm elections in the second presidential year, tends to create or tend to move upward with the equity market. But I want to stress, here's where we're at in the market cycle. Now, this is an iShare, the iShare ETF XT is the symbol, which is basically exponential technology companies. We are still in a downtrend. This is a chart of the price of that specific ETF. Again, you can see year to date, we are still in a downtrend. And yes, we've had a bump over the last few weeks, but the trend is still down. Though we've had a recent bump, and though the studies show that after the midterm cycle here, we tend to get upward moving equity markets, odds favor we're still going to head lower. Again, just looking at the charts, that's not a prediction, but odds favor that is likely the case. So again, what we look at is evidence of the past, different market cycles, studying different trends, right? We talked a little bit about, what happens post midterm elections, what tends to happen, again, at the beginning of the second presidential year where the market's down, for clues to what may happen in the future. Again, the studies show markets likely will head higher from here, but if we're simply looking at the charts and without knowing the context of the election cycle, the presidential years, and the data I shared with you earlier, I would say that, again, the trend is your friend until the end. It's a kind of an industry saying. Odds favor, we're likely continuing to head lower. I hope I'm wrong. I hope the market stabilizes and starts heading north. But as you know, we have the two biggest challenging problems or challenges right now in the economy. We have higher interest rates, the rates, creeping up. Look at the 30-year mortgage rates went from 3% at the beginning of 2022 to 7% now. That is an abnormality. Obviously, it's not normal. So you have rising interest rates, compounding with a slowing economy, and of course, inflation issues. Again, I don't have to tell you that, you all know that. All that to say is, if you would like a second opinion on your portfolio, just to understand where you are in the markets, where we are in the market cycle, how does it affect you, you can go on our website at nicholswealth.com, click on the upper right-hand tab, this Contact Us tab, fill out the information, and one of our advisors will reach out to you and answer your questions and hopefully give you some more confidence. Thanks again for watching. Bye-bye.